management. I think all of us are very much familiar with the business model that financial entities, particularly the banks, adopt. That is mobilizing deposits for the purpose of lending and investment and statutory obligations of regulators that we will have to fulfill. Point of some time, some more may get reflected in the form of liquidity risk, the interest rate, all are hooked together. So we will have to take a holistic view when we look at asset liability management. That is why I just wanted to put before you that asset liability management is not only the function of specialists at the bank, like a corporate office, who make policies and who put some kind of checks and balances, but it is the work of, he says, that the follow-up that they do, the kind of management of liquidity inflows and outflows that they monitor, they need to be very, very careful about that. So excess liquidity from the system, right from there, using the variable reverse repo rate auctions that we have started absorbing the liquidity. Either the RBI absorbs liquidity or pumps liquidity to ensure that the rates remain fairness, and that is why the Basel III now prescribes LCR, that is liquidity coverage ratio, so that you are in a position to better manage. So all the assets and liabilities portfolio is widespread, and we are in a position to harness the potentiality of business model from time to time. So the ALM organization, ALM process, and ALM information system. These are the three pillars of asset liability management process. The managing director of the any institution, and of course, they will be reporting to the subcommittee of the board on risk management. Asset liability management committee is normally headed by managing director. Earlier in public sector banks, chairman used to be the chairman of ALCO, because that is the importance of ALCO. The banks are in a position to make full use of the talent of asset liability management that is available in the system, so that they can remain competitive in the market. So ALCO should be apprised about risk of business, information of dead transactions. That means the transaction is over, then only data comes. That's the crux of ALCO functions. ALCO function is not, okay, you look at the data which has already been passed through the system, and the data is already there. If some deposit has come, it has already come. Some loan is disbursed, it is already disbursed. If there is no repayment in some loan, it is not there. So all these data points which we have, residual assets and liabilities changes at various places, will be able to transform the flow of assets and liabilities, and your structural liquidity gap in the bank has an implications on the structure of the balance sheet. That we should keep in mind always. Balance sheet risks are managed by setting limits, monitoring and implementing controls covering capital funding and liquidity, and it is responsible for the implementation of ALCO strategy. What is the ALCO strategy? ALCO strategy is not merely how to borrow and deploy funds to meet the gaps of the 11 time buckets, and what should be the optimized distribution of assets and liabilities in our balance sheet. That should be found out, and start a trail. Means it cannot be done. I agree, because many of our senior friends will say that how can we change it? We may not be able to change in a quarter, as I was saying, but a beginning can be always made. The different departments will do to ensure that your board is able to discuss the agenda points, because every department which prepares the agenda points for consideration of the board does a lot of homework So the board meeting is just a tip of the iceberg. Office and mid office, how the functions and the three lines of defense, that is a first line of defense, second line of defense, and third line of defense, how they collaborate with each other to ensure that the ALCO is given the right support. Because the ALCO, when it meets, it should have before it very relevant data to understand and be able to discuss the right kind of policies that need to be put in place, not be avoided. Because it is, as I was telling in the beginning itself, that at what rate, at what time, in what size we get the deposits or loan maturities is not in our hand. What we should do is of reporting to the ALCO, because ALCO will decide only on the basis of the reporting that happens. And these reporting has two dimensions which we need to understand. One is the data. So other channels, if they are going, we need to attract them back. Or since the GDP is rising now about 6.8%, 7%, that is different kinds of estimates that are coming. But whatever it is, since the GDP is 3.75 trillion, which was, if you recollect the GDP numbers, need to how to change the these dimensions. I think we need a lot of more application of mind at this stage now and compared to others. So that is why when you go further, there will be haircuts in your securities portfolio. So Punjab National Bank 142%, Bank of Baroda 133%, SBI 131%. SBI, given such a large 55 trillion balance sheet size, the way you want the cost of managing the liquidity risk, what you want to target, and given that there will be implications on the interest rate, because you want to borrow from the market. The weighted average call rate is some bank, sometimes it breaches MSF rate. Now that means what? It is much more than repo rate, much more than MSF rate in those to help banks meet the requirements of liquidity. And that is why it keeps a very eagle eye on the movement of liquidity system in the banks. So the short point that I want to harp on, how you manage your ALM will decide what will be your interest cost for managing liquidity risk. What are the mismatches in the ALM? And then visualize your interest rate obligations. So interest rate risk is the risk where changes in market interest rate adversely affect banks' financial condition. Or we have to receive interest on our deployment. And that is a function of how the markets evolve. So interest rate risk management is the banking book risk management. Like now we have two kinds of interest in floating rate interest rates. One is the interest rates on loans linked to external benchmark. So that is why most of our loans are having floating interest rates. Because the fixed interest rates, it will be very, very costly for us, because we do not know how the market is going to evolve, how the interest rate curve will change because of this pandemic. See the economic value perspective and earnings perspective to and the impact of interest rate is earnings. It affects the net interest margin, net interest income, and it has ramifications on the profitability of the bank. Economic value, that is the capital base, also keeps changing if your interest rate risk is too much to absorb perspective. So interest rate risk management is another function of ALCO. At what point of time, whether later, now, or what is the composition, we need to understand the intricacies of synchronized. Because if you are taking too much of risk, no, like you maintain gaps in the liquidity and you raise the interest rates on the other side, and you do a lot of mathematics as far as the interest rate earnings and deployment is concerned, you may temporarily, for some time, get better interest rates. It is just like using steroids for treatment. Interest rate earning analysis and liquidity gap analysis have to be synced together. Otherwise, the unexpected change in the interest rates, duration of the cycles could stretch. In normal times, duration of the interest rate cycle could be because the inflation has shot up to such an extent that all the central banks worldwide has to increase the interest rate so fast. 250 basis points we have increased. Full transmission of interest rates have not happened, though Saudis of Yemen, that has created a lot of havoc as far as the geopolitical risks cannot be estimated, because geopolitical risks, the ramifications to some countries may be immaterial, to some countries it may be material, to some countries it can be very high. So these are all some of the things that. So the point is, please make analysis of gap analysis on one side and interest rate earnings on the corresponding gap analysis on the other. So the gap report you have to, one of the key issues in preparing gap report to identify is the time horizon that you need to see, residual maturity period and things like that. I will share this interest rate risk. There are two models as far as there are a lot of models that are coming up now. Now, what is a model? Many people think that model is something very, very difficult. It's rate sensitive liabilities. Its objective is to measure expected net interest income research. We have to invest a lot of our resources on research to find out which policy, public policy, which policy of the bank will be more remunerative to the bank in the coming years to come, and how the product profile is to be changed, what is the psychology of the customers, how they are going to change their behavior in the times to come. All these things require not only CRM. If you don't galvanize a new body of knowledge, then you will not be able to add value to the organization. Just growing, that's okay, fine. Like you can grow at about 10%, 12%, say twice the GDP growth rate or less than GDP growth rate. You can grow 2.5 times of the GDP growth. You cannot unless you are innovative in that. So what is innovation? Innovation is to see how the future is going to evolve and align your strategies according to that. Interest rate earnings will happen, and what is the gap in that. So there will be a gap in the liquidity. There will be a gap report for interest rate changes. That banks are unduly exposed to the risks which they need to control. And that is the reason why RBI has been harping on the management of liquidity and the portfolio and the exposures. Exposures one has to, and then the co-lending with the NBFCs for interest earnings and be able to manage our liquidity. Duration gap analysis. On the other hand, traditional gap analysis is essentially a going concern analysis, whereas the duration gap analysis is economic value, which comes at a later stage. Payment is made. All these calculations are on the residual maturity and on the basis of what we call the net present value of money. Because today's money is more valuable than tomorrow, and hence we calculate duration model and modify. There is a modified duration also. Modified duration gap analysis. You have structural liquidity gap report, that is 11 time buckets.
This thing, but I am not talking.
Okay, fine. So how to go about now? Should we?
Any questions if they have?
Yeah, any questions?
If don't have a question, then we can
if
buy
our
it.
friends are having, they can always talk to us to manage the risk. It all depends upon the ability to measure the risk so that we can mitigate the risk.